Preparing for a risk analyst at Aegon interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What are the main risks faced by an insurance company such as Aegon? An insurer faces several interconnected risks. Market risk arises from interest rates, equities, spreads, and currencies, credit risk from issuer or counterparty defaults, and insurance risk from mortality, longevity, morbidity, or claims experience. Liquidity, operational, conduct, cyber, strategic, and regulatory risks also matter. At Aegon, I would assess each risk against liabilities, capital, customer outcomes, and risk appetite rather than viewing exposures in isolation. Diversification and strong controls reduce, but never eliminate, vulnerability. While answering, focus on market, credit, insurance, liquidity, operational, conduct, strategic, and regulatory risks. Then explain how these risks interact across products, investments, customers, capital, and long-term financial resilience. Question 2. How would you explain the difference between risk and uncertainty? Risk describes uncertain outcomes where probabilities can be estimated using data, models, or expert judgment. Uncertainty is broader. The possible outcomes or their probabilities may be poorly understood. For example, historical lapse data can help quantify normal policyholder behavior, while a novel cyber event may require scenarios instead. I would communicate assumptions, confidence levels, and limitations clearly, then use sensitivity testing and expert challenge so management does not mistake model precision for certainty. Make sure to cover measurable versus unmeasurable outcomes, probability distributions, model limitations, data quality, scenario analysis, and why uncertainty requires judgment, governance, conservatism, and clear communication to decision-makers. Question 3. What is an insurer's risk appetite, and how is it used? Risk appetite defines the amount and type of risk an insurer is willing to accept while pursuing its strategy. It normally includes quantitative limits for capital, liquidity, earnings volatility, market exposures, and concentrations, alongside qualitative standards for conduct and operational resilience. I would monitor indicators against thresholds, investigate breaches, and escalate them promptly. Effective appetite is not a document on a shelf. It guides underwriting, investment, product, and capital decisions throughout the business. In your answer, discuss board-approved boundaries, qualitative and quantitative limits, capital, earnings, liquidity, customer outcomes, escalation triggers, monitoring, and how appetite translates strategy into controlled day-to-day decisions. Question 4. How do rising interest rates affect an insurance company? Rising rates usually reduce the market value of existing bonds, but they can improve reinvestment yields and reduce the present value of longer-dated liabilities. The net effect depends on asset liability duration, guarantees, hedges, policyholder behavior, and accounting or regulatory valuation. I would examine both immediate capital sensitivity and longer-term earnings benefits, then test parallel and non-parallel curve shifts. A duration mismatch can create material volatility even when the overall rate move appears favorable. Be sure to mention asset and liability duration, reinvestment income, bond prices, discount rates, solvency, guarantees, policyholder behavior, hedging, and why the impact differs across life, pensions, and protection portfolios. Question 5. What is asset liability management, and why is it important for Aegon? Asset liability management aligns investment assets with the timing, currency, duration, inflation sensitivity, and optionality of insurance obligations. Its purpose is not simply to maximize asset returns, it is to support reliable benefit payments while controlling capital and earnings volatility. I would compare projected asset and liability cash flows, identify mismatches, and evaluate hedges or portfolio changes. For example, a long-duration annuity book may require bonds and derivatives that better match its payment profile. Focus on matching liability cash flows, duration, currency, inflation, and optionality with assets, while discussing liquidity, solvency, reinvestment, hedging, and the consequences of mismatches under stressed market conditions. Question 6. How would you assess market risk in an investment portfolio? I would begin by decomposing the portfolio by asset class, issuer, sector, currency, maturity, rating, and strategy. Then I would calculate relevant sensitivities, such as duration, spread duration, equity beta, and foreign exchange exposure, supported by stress tests and, where appropriate, VAR. I would compare results with risk limits, capital metrics, liquidity needs, and portfolio objectives. Finally, I would challenge data and model assumptions because measurement error can itself distort risk decisions. While answering, cover exposure decomposition, sensitivities, historical and stressed VAR, duration, spread, equity, currency and concentration risk, scenario analysis, limits, liquidity, and independent validation of results. Question 7. What is credit risk, and how would you monitor it in an insurer's bond portfolio? Credit risk is the potential loss arising when an issuer or counterparty fails to meet its obligations, including through downgrade or spread widening. I would monitor ratings, credit spreads, leverage, interest coverage, liquidity, sector concentration, issuer limits, and watchlist movements. Expected loss can be framed using probability of default, exposure at default, and loss given default. If deterioration appeared, I would investigate the cause, reassess valuation and capital impact, and consider reducing or hedging exposure. Discuss probability of default, loss given default, exposure, ratings, spreads, migration, concentration, collateral, watchlists, counterparty risk, early warning indicators, and portfolio actions following deterioration. Question 8. How would you distinguish credit spread risk from default risk? Default risk is the possibility that an issuer fails to pay principal or interest, creating a realized credit loss after considering recovery. Credit spread risk is the possibility that required compensation for credit risk changes, reducing the market value of a bond even when payments remain current. A 5-year corporate bond can therefore lose value after spreads widen without defaulting. I would analyze both risks separately because their drivers, timing, hedges, and capital effects differ. Make sure to explain market repricing versus realized non-payment, valuation effects, duration, recovery assumptions, capital impacts, correlation, and how a portfolio can suffer spread losses without any actual default. Question 9. What is liquidity risk in insurance, and how would you test it? Liquidity risk is the inability to meet obligations when due without unacceptable cost or forced asset sales. I would build cash flow projections covering premiums, claims, maturities, expenses, collateral calls, and policyholder surrenders, then stress assumptions and market liquidity. I would review liquid asset buffers, concentration, encumbrance, and contingency funding options. The analysis should distinguish temporary timing pressure from structural imbalance and include clear escalation triggers, because solvency does not guarantee immediate cash availability. In your answer, address cash flow forecasting, claims and surrender payments, collateral calls, asset liquidity, market depth, stressed outflows, contingent funding, encumbrance, and escalation of emerging shortfalls. Question 10. What is Solvency II, and what would you monitor as a risk analyst? Solvency II is a European insurance regulatory framework built around 3 pillars: quantitative capital and valuation, governance and risk management, and supervisory reporting and disclosure. I would monitor the solvency capital requirement, eligible own funds, coverage ratio, risk concentrations, model changes, and sensitivities under stresses. I would also understand whether exposures are captured through the standard formula or an approved internal model. The practical objective is resilient capital, not merely passing a reporting threshold. Be sure to mention the 3 pillars: solvency capital requirement, own funds, risk margin, governance, reporting, standard formula or internal models, sensitivities, and the importance of maintaining capital above risk appetite. Question 11. What is an ORSA, and how does it support management decisions? The own risk and solvency assessment is a forward-looking process that evaluates whether the insurer's risk profile, capital, and liquidity remain adequate over its planning horizon. I would connect business strategy to risk identification, stress and scenario testing, capital projections, and management actions. A useful ORSA might show how a rate shock, lapse surge, or credit event affects solvency and earnings. Its value comes from influencing pricing, investment, reinsurance, and capital decisions, not simply producing a report. Focus on forward-looking own risk and solvency assessment, business strategy, stress testing, capital planning, risk profile, governance, scenario analysis, and how conclusions influence decisions rather than merely satisfy regulation. Question 12. How would you approach a stress test for a life insurance portfolio? I would start by identifying material vulnerabilities, such as rates, spreads, equity markets, longevity, mortality, lapses, or inflation. I would define coherent scenarios rather than applying unrelated shocks, model impacts on both assets and liabilities, and include policyholder behavior and management actions where credible. I would assess solvency, liquidity, earnings, and operational consequences, then compare results with appetite and recovery options. Reverse stress testing could reveal which combination of events threatens viability. Discuss selecting material scenarios, translating shocks into assets and liabilities, behavioral responses, diversification, capital and liquidity effects, management actions, reverse stress testing, and communicating results with limitations. Question 13. What is model risk, and how would you control it? Model risk is the possibility that a model produces misleading results because of flawed design, data, implementation, assumptions, or inappropriate use. I would control it through clear ownership, documented methodology, independent validation, outcome testing, benchmarking, sensitivity analysis, and formal change approval. Material limitations should be visible to users, with compensating controls where necessary. In an insurance setting, I would pay particular attention to long-term assumptions, sparse data, and interactions between asset and liability models. In your answer, cover incorrect design, implementation, data, assumptions, validation, benchmarking, change control, limitations, documentation, expert judgment, governance, and monitoring model performance after deployment. Question 14. How would you investigate an unexpected movement in a solvency ratio? I would first validate the source data, reporting period, calculation, and comparison basis. Then I would decompose the movement between eligible own funds and the solvency capital requirement, separating market effects, liability changes, model updates, business growth, dividends, and management actions. I would reconcile movements to finance and actuarial reports, quantify material drivers, and challenge unexplained items. If the decline breached a threshold, I would escalate promptly with proposed mitigations and a clear root cause narrative. Make sure to cover data validation, numerator and denominator decomposition, market movements, assumption changes, model updates, capital actions, reconciliation, materiality, root cause, and timely escalation. Question 15. How do policyholder behavior and lapse risk affect insurance risk analysis? Lapse risk is the possibility that policyholders surrender, stop paying, or alter contracts differently from assumptions. Behavior may respond to rates, guarantees, affordability, competitors, or market conditions, and it can create adverse selection or liquidity pressure. I would segment experience by product, duration, customer profile, and economic environment, then compare actual behavior with assumptions. Stressing higher or lower lapses is essential because behavior can simultaneously change fees, claims, cash flows, capital, and asset liability matching. Discuss surrender assumptions, adverse selection, interest rate sensitivity, guarantees, liquidity, profitability, segmentation, experience monitoring, stress calibration, and how behavior can amplify asset liability mismatches. Question 16. How would you assess operational risk in a financial services business? I would assess operational risk by mapping critical processes, identifying failure points, and evaluating controls across people, systems, data, vendors, and procedures. Evidence would include incidents, near misses, audit findings, key risk indicators, access reviews, and business continuity tests. I would distinguish gross from residual risk and assess whether controls are designed and operating effectively. For a financial institution, cyber and third-party resilience deserve special attention because disruptions can affect customers, liquidity, reporting, and reputation simultaneously. Be sure to mention process mapping, risk and control self-assessments, incidents, key risk indicators, people, systems, vendors, cyber threats, business continuity, root causes, and remediation tracking. Question 17. Tell me about a time you identified a risk or control issue. In a reporting project, I noticed that a spreadsheet used for exposure limits contained inconsistent formulas across several tabs. I reconciled the outputs to source data, quantified the potential impact, and documented the issue rather than correcting it silently. I discussed it with the owner, proposed a controlled template with validation checks, and asked for independent review before release. The process was corrected before reporting, and the team added a change log. That experience reinforced the importance of evidence, transparency, and timely escalation. Focus on a structured STAR response: context, analytical evidence, challenge, stakeholder communication, escalation, remediation, measurable outcome, and what you learned about control effectiveness or professional judgment. Question 18. How would you communicate a complex risk analysis to senior management? I would lead with the decision and the main risk, quantify the potential impact, and explain the principal drivers in plain language. A concise dashboard could show exposure, trend, appetite threshold, stress outcome, and proposed action, supported by technical detail in an appendix. I would distinguish facts from assumptions and state uncertainty clearly. For senior management, the analysis should answer what changed, why it matters, what can be done, and when escalation is required. In your answer, cover decision relevance, concise executive summaries, material drivers, charts, scenarios, uncertainty, recommended actions, audience adaptation, challenge, and avoiding technical detail that obscures the conclusion. Question 19. What Excel or data analysis techniques would you use in a risk analyst role? I would use Excel for reconciliations, pivot tables, lookups, conditional logic, sensitivity tables, and clear risk dashboards. For larger datasets, I would use SQL or Power Query to extract, transform, and validate information reproducibly. I would build checks for duplicates, missing values, unexpected movements, and totals that fail to reconcile. Automation should reduce manual error, not remove judgment, so I would retain version control, documentation, review evidence, and independent reasonableness checks. Mention data validation, reconciliations, pivot tables, lookups, conditional logic, sensitivity tables, charts, Power Query or SQL, automation, version control, audit trails, and independent reasonableness checks. Question 20. Why do you want to join Aegon as a risk analyst? I want to join Aegon because insurance and retirement businesses require disciplined risk thinking over long horizons, with decisions affecting both capital resilience and customer security. The role would let me combine quantitative analysis, financial markets, data, and communication while learning how risks are managed across assets, liabilities, and operations. I am particularly motivated by work that turns analysis into practical decisions, such as improving monitoring, challenging assumptions, and supporting sustainable outcomes for policyholders and the business. Be sure to connect Aegon's insurance and retirement focus with your analytical skills, risk culture, customer impact, long-term perspective, collaboration, learning goals, and motivation for the specific role. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.